Welcome to the Optivest case file. Today, we're prying open the books on Ex-Pack Corrugated Cartons PLC. We're going to follow the money trail, starting from a really promising IPO, right through a global crisis, and all the way to a balance sheet that might be holding a pretty dangerous secret. Let's dig in.
All right, but first, the usual ground rules. Just so we're clear, this analysis is for educational purposes only. It is absolutely not investment advice. We're here to connect the dots and understand the story the numbers are telling us using only publicly available information. So here's the central mystery we're looking at today. You've got a company that goes public with a big promise, a brand new factory. Then a massive crisis hits, and suddenly that plan is out the window. So the question is, was this a smart, adaptive move, or was it a sign of some deeper trouble brewing under the surface? Our job is to follow the evidence. Okay, to really understand what's going on with the company, we first have to zoom out and look at the world they're operating in. There was a serious storm brewing on the global stage, a perfect mix of major challenges and, believe it or not, some unique opportunities. Let's set the scene. Imagine it's early 2026. A geopolitical crisis flares up in the Middle East. Now, for an export-heavy economy like Sri Lanka, this isn't just some distant headline on the news. No, it's a direct threat to the bottom line. The country's biggest industries, we're talking tea, apparel, they're right on the front lines. And guess who supplies their boxes? Ex-Pack. And this creates a really volatile situation. On one hand, you've got these huge headwinds, right? The threat of new US and global tariffs that could just crush exporters. But on the other hand, there's this surprisingly powerful tailwind. The UK's Developing Countries Trading Scheme, or DCTS, offers this amazing lifeline of tariff-free access. It's the very definition of high risk versus high opportunity.
So where exactly does Ex-Pack fit into this whole messy picture? Let's bring our subject Ex-Pack PLC into focus and connect these big global pressures directly to the company itself.
This, right here, is from their own annual report. It says it all. Ex-Pack is the go-to packaging supplier for Sri Lanka's biggest export sectors. So when tea and apparel exports get hit by tariffs, you better believe Ex-Pack feels that pain immediately. Their fate is literally tied to their client's success. And this brings us to the first big clue in our investigation, a major deviation from the promises they made to investors during their IPO. Let's take a closer look at this sudden and very interesting change of plans. Let's just walk through the timeline. Back in October 2021, the IPO pulls in about 700 million rupees, all earmarked for a new factory. But then, fast forward to 2023, and the Sri Lankan economic crisis just makes that plan impossible. Costs are through the roof. So by early 2024, management starts signaling a change. And by April, it's official. The original promise is gone. The new plan? Forget the new factory. Let's just restructure the one we already have. Now, what Ex-Pack did here, there's actually a name for it. It's called a strategic pivot. And this isn't just a small course correction, It's a fundamental change in their entire strategy. Now, while it's often a necessary move to survive tough times, for the investors who bought into that original story, well, it raises a whole lot of questions. And, one of the biggest questions is always about the money. So let's get to the financial core of this case file, because we need to see how this new plan was actually funded. And this, my friends, is where we find a major red flag. Okay, so the company did manage to get the new machinery installed and expand its capacity, which on the surface sounds great. But the money from the IPO wasn't nearly enough, especially with costs soaring. So you have to ask, how did they pay for it all? Where did that cash come from? And here is your answer, 97%. By March of 2025, Ex-Pack's debt-to-equity ratio hit 97%. Let that sink in. This means for basically every single rupee shareholder money in the company, there was almost a rupee of debt sitting right next to it. That is a seriously high-risk level of financial leverage. And look, this wasn't a slow, gradual increase over time. This debt load absolutely exploded. It went from an already high 72% in fiscal year 2024 and just shot up to 97% only 1 year later. The key takeaway here is that this expansion was paid for with a whole lot of borrowed money. So, for an everyday investor, what does a 97% debt-to-equity ratio really mean? Well, it means a ton more financial risk, especially when the economy is already shaky. It means higher interest payments are going to eat away at any potential profits. It means the company has very little wiggle room to grab new opportunities or even survive another crisis.
And ultimately, all of that puts your investment, your shareholder value, at risk. Now, of course, management knows this is a problem. They're not blind to the risk. So they've come up with a solution, a pretty high-stakes gambit, if you ask me, to tackle this mountain of debt. Let's break down their plan to deleverage. The plan is actually pretty simple. Sell off a key asset. What are they selling? A valuable 2-acre plot of land. The most important word here is unencumbered. That just means they own it outright, no loans attached. It's a clean asset they can turn into cash to pay down all those borrowings. So, the gambit is pretty straightforward. Step 1, you identify that clean asset, the 2-acre plot. Step 2, you sell it for what it's worth. Step 3, you take every last rupee from that sale and use it to pay down debt. And the final goal, step 4, is to get that scary debt-to-equity ratio back down to a much safer level. Now, if you look at it from the company's perspective, which they lay out in their latest annual report, the picture is all sunshine and optimism. They see themselves as leaders in the industry, stronger and better equipped than ever before. They really believe that this painful pivot and all the new machinery have set them up perfectly for success. And that brings us right to the final, critical question of this case file. Is this plan to sell off a valuable piece of land a brilliant strategic masterstroke to secure the company's future? Or is it a desperate, forced move, basically selling off the family silver because they got cornered by a mountain of debt? We've laid out all the evidence. Now, it's up to you to weigh it.